This episode is brought to you by Newline by Fifth Third. Drive your fintech forward with the embedded finance platform designed for enterprise fintech and backed by a leading financial institution. Discover how Newline can transform your business at newline53.com. The Fintech Takes podcast is also brought to you by Paddle. Need more revenue, more growth, and more time? Over 5,000 digital businesses trust Paddle as their merchant of record, or MOR. Unlock more revenue, more growth, and more time. Get more at paddle.com. Hello, and welcome back to a very special edition of Fintech Takes. This week we have a guest episode with a returning guest, Rob Blackwell, Chief Content Officer at IntraFi and host of Banking with Interest, which is one of my favorite podcasts that gets into the sort of nerdy weeds of bank policy and regulation. Rob is based in Washington, D.C. and has covered the bank regulatory space for a very, very long time. So he knows extremely well the lay of the landscape. And it's kind of funny. The last time he was on, we mostly just spent time asking what the hell is going on. And we sort of pick up the thread on that exact what the hell is going on conversation this week. We talk about Scott Bessant at the Treasury Department and his atypical approach to trying to control and direct bank regulatory efforts in a way that we really haven't seen before. We talk about the Genius Act and stablecoin legislation that is currently making its way through Congress, which has engendered some surprising pushback relatively late in the process that may end up causing some problems for the legislation. We also, of course, talk a little bit about open banking, which has been the subject of a lot of drama this week. The CFPB has indicated to the industry that they are likely to actually rescind the open banking rule that was developed under the Biden administration, which is a huge, huge change and will have some significant implications for everyone in financial services. So Rob and I spend a little bit of time talking about that. And then, as we always do, we talk a little bit about silly things that have nothing to do with fintech at all, including the movie that Rob feels is most underrated and the proper way to cook a potato. So, if that intrigues you sufficiently, I would encourage you to keep listening to this week's special episode with Rob Blackwell. Okay, Rob Blackwell, welcome back to the podcast, sir.
Oh, thank you for having me. I'm so excited to be back.
I am excited to have you. I think if I'm remembering right, we're not keeping score around here, but if I'm remembering right, this is now your second time on the Fintech Takes podcast, which now matches up with the two times I have been on your wonderful podcast, Banking with Interest. So around we go on the merry-go-round, and given all of the crazy stuff that's happening in your neck of the woods, I couldn't imagine a better guest this week. So appreciate you taking the time.
Oh, my pleasure. Really, anytime.
Well, I'm probably going to take you up on that a lot, but
likewise.
A thing that we did the last time you were on the pod, and a thing that you have been doing on your podcast pretty consistently, is a little bit, which we have sort of, I think, termed collectively, what the hell is going on? So we're just going to continue this sort of theme because I have many, many questions for you, touching on a number of different sort of what the hell is going on issues, centering around Washington, D.C. and the current bank regulatory scene. The first one I wanted to do was actually one that you emailed to me, and it was kind of a mysterious one from my perspective because you were like, do you want to talk about what's going on with Scott Bessant and Treasury? And I was like, I don't even know what that means, but I would love to talk about that. So let's start there, Rob. What the hell's going on with Scott Bessant, Treasury, and the sort of role of the Treasury Department under this Trump administration as it comes to bank regulatory policy?
Yeah, it's a really fascinating topic. I don't think it's been covered as much as it warrants. But there's a huge shift in the way this Treasury Secretary is approaching the job, at least when it comes to bank regulatory policy, than previous ones. Mm-hmm. And I go back a ways. I mean, I've been in the banking fintech game for over 25 years. So I've covered a number of Treasury Secretaries. And I'm not telling you that they don't get involved with bank regulation. They do. But they tend to do it in two ways. One, there's a crisis. So Hank Paulson or Tim Geithner, in the middle of a crisis, they're paying a lot of attention to it. The other is issues bubble up to them. So Janet Yellen, who's the immediate predecessor of Scott Bessant, obviously extremely well qualified to take on bank regulation. She was the former chair of the Fed. So she knows as much about bank regulation as anyone out there. But yet, if you watched her during the Biden administration, she mostly was taking the traditional view. She had other items in her remit, other priorities that the Treasury Secretary typically focuses on. And so she was off doing that. And if issues came to her, if she was asked about Basel III, she was usually deferring back down to the regulators she had there. So she deferred to Michael Barr, say at the Fed, or Michael Hsu at the OCC, or Marty Grunberg at the FDIC. They were the ones who were likely to take issues to her, or they'd let Graham Steele, as a Treasury Assistant Secretary, handle it. That's not what's going on here. This is Scott Bessant is definitely taking the reins of bank regulatory policy in a way that I haven't seen before. And it really is fascinating because I watched him give a speech last month to the ABA. Typically speaking, it's not unusual for Treasury Secretaries to speak there, but typically they talk about whatever the issue of the day is, or, broad strokes. They don't get into the weeds of bank regulatory policy. And he jumped into it. I mean, he was talking to bankers, and he was running through a litany list of things he wants to do. It's very ambitious. So it's just very surprising. And, earlier when the Trump administration, was still yet to take power, but after they won the election, there was a lot of talk about consolidation, right? And there was a lot of talk of bank regulatory consolidation. And that has a lot of hurdles to it. For one, you really need a law to do it. It's nobody, and Congress really wants to do this. For another thing, I think they thought banks would be really excited about consolidation. And they weren't. Broadly speaking, most of them kind of like keeping their regulator. They don't want to lose their individual regulator like the FDIC or something like that. They don't want a super OCC. So there are issues there. And I think all of that talk was really about Treasury trying to assert we're in charge. And I will say they have a good legal backing for that. The Dodd-Frank Act put the Treasury Secretary in charge of FSOC. And so that's the sort of legal standing they have to say, we're the ones running the show and the agencies are going to defer to us. And I think that's the way you are going to see bank regulatory play out in the second Trump administration.
That is fascinating. And it kind of makes me think a little bit about a broader trend, I think, that we've seen under the second Trump administration, which is everyone who is participating in the administration seems to have a much sort of keener understanding of, I have an opportunity to grab some sort of land and hold on to it, right? And it is interesting because under other administrations, and you talked about the Biden administration and Janet Yellen at Treasury, like it seemed a lot more like there was sort of philosophical alignment across a larger group of people. And then because of that philosophical alignment, a certain level of trust that, like, I'll do my part, you do your part, you do your part. We'll all kind of trust that we're all taking care of our own little part of the store in sort of coordination for the administration's larger goals. But there was sort of like a unifying sort of philosophical view. And not that obviously the regulators didn't disagree with each other. I, in particular, always thought the FDIC board was kind of interesting under the Biden administration because you had Hsu and you had Grunberg and you had Chopra, and they were all kind of coming at things from a very different perspective. So you definitely had different viewpoints. But under this Trump administration, my observation has been there seems to be very little trust between the different sort of regulatory heads or the different people who've been sort of temporarily put in charge of these different areas, which maybe extends all the way up to Treasury. Like it sort of seems like, I need to have my hands on the wheel here because I want to see this done in a certain way. And if I don't, there might be someone else who has a very different vision that's going to take it, kind of in a totally different direction. Does that seem kind of consistent with what we've seen in the Trump administration so far?
I'm almost there. I don't think it's trust, but I do think it's control. So we're talking about two sides of the same thing.
Sure.
I think Scott Bessant trusts the regulators that are in place now, and I think he trusts the ones that have been nominated for the job. However, I also think he wants to be in the lead, and he's going to be in the lead. And he is saying to them, I am in the lead. And you sort of get on board or you don't. But the era of the independent agency, and we can debate how illusory that was, but it did exist in some form, but I don't think it's really going to exist here. Do I think that means that, Treasury is going to be messing around with an enforcement action about bank B or C or somewhere? No, I don't. That's not what I'm talking about. I just mean when it comes to policymaking. I think Treasury wants to be in charge. Treasury is going to be in charge. And I don't know if it's trust so much as they feel like they're going to own this. They might as well own it anyway. I do think you are also speaking to the fact that there are always factions in administrations.
Yeah.
And we see that a lot. But typically speaking, what happens is the factions kind of fight it out, behind the scenes. You get glimpses of it, rumors of it. Sometimes it makes it to the press. Sometimes you just hear crap, right? This administration, they will battle it out in public. They will battle it out in private. There are articles there. That's often why there's this sense of, we're doing this thing. No, we're doing that thing. And I think Treasury doesn't want to see that happen in the bank regulatory space. They just don't want to see any factions sort of vying for control. Now, how much they'll be successful, I don't know. You already sort of see some weirdness around the CDFI fund. Like, for example, OMB in the budget wants to really take out the CDFI fund. Scott Bessant has been very adamant that he wants to defend the CDFI funds. And in fact, CDFIs help rural communities, so red states. So, you're going to see some push and pull there. But I think Treasury is trying to preempt any sense of divergence.
Yeah, I mean, maybe that's kind of the animating impulse here is like, we want to get ahead of any of these dynamics that might form over time where people are sort of pulling in very different directions. Because you're right. I mean, there's always a certain amount of tension and disagreement, but a lot of times in the past, it seemed to have gotten mostly worked out behind closed doors. And then there was sort of a unified front once, you sort of got out in public. And that's less the way that this Trump administration is than almost any administration I've seen before. And, I think the other element to all of this is, and there's been lots of reporting on this in other areas outside of bank regulation, but there is certainly an element of, if I can get 5 minutes in the Oval Office, or if I can do a television hit on a show that I know the president watches, I can unusually steer a policy thing in my direction and have more, like, normally that's not the way that those decisions get made or the way that you sort of tip the balance on things. And there's a little element of chaos and uncertainty baked into, if I really care about something and I can get the right 5 minutes with the right person, I can dramatically steer a change that I might want to see. And that feels like that introduces, again, maybe trust is the wrong word, but it seems like it introduces a little uncertainty into the sort of working dynamics between all these different folks.
I agree. I do think in this case, what you're talking about, the right person is really the president. The president seems to do what a lot of reporters do, what I did as a reporter, which is you tend to be most influenced by the last person you talk to when you're writing a story. Yeah. And so not unreasonably, the president, I think in most administrations, your access to the president is very limited. Yeah. And so you don't get that opportunity to pitch Biden 5 minutes before he makes a decision. And that's not true with Trump. There are many ways to access him. It's very clear that if you know his cell phone number, he'd pick, if you and I could call it, and he would probably pick up, and we might have a delightful conversation. You don't know. So it's just the kind of opens up this other element of unpredictability.
Yeah, it's very populist in that way. So no, it is. It's just a very interesting dynamic that does seem to sort of ripple through, particularly given the fact that we already did sort of 1.0 version of this. And so I feel like everyone who's sort of in the administration has a better sense of what this dynamic is. And it does seem to be sort of proactively shaping how they're doing their jobs. So no, it's fascinating. I want to switch gears because I wanted to make sure I asked you about stablecoins.
Oh,
stablecoins. We talked about it last time that you and I podcasted.
And we'll probably talk about it next time when you're on my show or I'm on your whatever. I don't know.
I think we will. Yeah, I think Rob, unfortunately, I think we're destined to talk a lot about stablecoins. I've been sort of a reluctant participant in the discussion in some senses where I'm like, oh God, do I really have to learn about this? And then it's like, yeah, I think I do have to learn about this. And I think you've been kind of on the same journey in terms of, this is now front and center as a topic. And in fact, the most sort of recent news is pretty interesting in this regard because we have Congress working on a couple of bills to create sort of a regulatory framework for payment stablecoins in the US. And it was announced very recently that a roadblock had been sort of hit on this particular issue, where a group of Democrats have announced that they would not vote for the Genius Act, which is the act going through the Senate right now, without seeing some, sounds like, reasonably significant changes. And what was fascinating about this is that the stablecoin efforts so far have been, I would say, for our current times, fairly bipartisan compared to other issues. Not that all Democrats are on board. Elizabeth Warren has a lot of concerns, for example, but there was a decent amount of bipartisan support for creating a regulatory framework for stablecoins. This objection on the part of these 9 Democrats seems to have kind of caught everyone by surprise a little bit. So it's been I guess I would say sort of a week of scrambling, it seems like, in terms of trying to understand what the objections are and trying to find a path forward, potentially maybe calling Democrats bluff and seeing if they're really serious about this, or if this is just sort of a negotiating point and trying to get some leverage. So I know you've had some conversations with folks who've been really doing a lot of reporting on this, and you've been pretty close to it. What have you kind of sussed out in terms of where this objection is coming from and what changes these Democrats might want to see in the bill?
Yeah, it's a really good question. You referenced the fact that I've been putting headlines, what the hell's going on?
Yeah.
And I almost wish I'd hung on to that headline until this latest blow up, because I used it too many times and I had to walk away from it because we thought we knew what was occurring. And you had this dynamic where this bill was on a fast track. It's already gotten through the House Financial Services Committee. It's gotten through the Senate Banking Committee. It is early May right now. That is remarkable speed. And I think it's a surprise, by the way, for many people in the banking industry. I gave a talk to a conference last week, and I don't think sometimes at the sort of rank and file level, people have really digested how fast this thing is moving. And partly it's moving because Democrats have always been interested in this subject. Maxine Waters was interested in this subject. She talked a lot about it with then Chairman Patrick McHenry. So partly there's always been bipartisan interest and they just couldn't work out the details. But then they suddenly, once the Republicans had control of all levers of power in government, they were moving ahead. Democrats didn't want to hold it up because there's a lot of crypto money in that past election. And they looked at that and said, hey, we should be making a deal that we can make a deal. So they made a deal. So what blew up the deal? Well, what blew up the deal is President Trump keeps doing things that are making them increasingly uncomfortable, making some Republicans uncomfortable, not that they will admit it in public, making the crypto industry uncomfortable, which is kind of hard to do.
It is.
Yeah. So, I mean, and there are two important things. The most important thing to know is that Trump's stablecoin was chosen for a $2 billion investment in Abu Dhabi in Binance, which is the crypto firm. Yeah. So what you have is the president's stablecoin directly benefiting monetarily from the investment by a foreign government. Yeah. Right. To be clear, the coin didn't get $2 billion, but it's the method of payment. So it's collecting a hefty fee. Yeah. And we're talking tens of millions, maybe hundreds of millions of dollars. I'm not sure, but we're talking about a lot of money. And this really angered Democrats who've been worried from the beginning that Trump and his family stand to gain personally from this. When we were talking about stablecoin legislation last year, Trump didn't have a stablecoin.
Right.
That happened after he was elected president again. And it already had made the negotiations where I said Maxine Waters was on board with the negotiations. She walked out. After that point, she was like, I can't do this. I'm not going to participate in something that could directly benefit the president. You also, separate from the stablecoin, have a meme coin that Trump's has. And that meme coin, to the holders of it, they've been offered benefits like a tour of the White House or dinner at the White House. Yeah. And that is also, there is, in theory, nothing stopping a foreign power from buying up a lot of the meme coin and then getting access to Trump. And we just discussed the ways in which access to Trump is very critical now.
That's the other way. That's the other way we could get access to him, Rob, is like if you and I pooled our money, I know you're doing pretty well. We could buy a lot of Trump coin. And I mean, we could like get pretty direct access pretty quickly. Wasn't it? There was the other crypto guy, Justin Sun, right, who got basically a deal with the government over some pending criminal charges that essentially happened right after he made a major investment in Trump coin. He's one of the largest holders of it, as a matter of fact. And so it's not like, oh, theoretically, this could be a problem. This is like in practice, we are seeing this happen on a large scale right now. And the Abu Dhabi Binance deal seems like it was the precipitating thing that happened recently that might have derailed things.
It's kind of the straw that broke the camel's back, if you will, because
a big piece of straw.
Right. A big piece of straw. It's a huge piece. And, the backers of the bill will say, well, this is why we need regulation of this space. But there's nothing in the bill, as I've currently seen it, that would address anything that we just discussed. So that's why Democrats are upset. And I should say Republicans are now getting waffly. You had Senator John Kennedy the other day. He was raising unspecified concerns. Now, he voted for the bill in committee, but he's suddenly saying, I'm a no on this bill. Senator Hawley said he was worried that big tech could use this bill to gain more dominance. Well, now he's sounding like some community bankers I know who've been worried about this from the beginning. So that's interesting that he's now getting that message. I don't know. What I don't know is how long is the pause? How great is the gap between Democrats and Republicans, and just how far are each side willing to give and to push? We could have a situation where by the time this episode airs, it's all worked out again.
Yeah.
Or we could have a situation where we now enter a long, drawn out period of negotiation. In a way, President Trump has given Democrats a gift. I know it doesn't seem like that, but we said early on that the Democrats have been worried about all that crypto money, and so they don't want to appear anti-crypto. Well, the crypto industry can look at what the president is doing, and they are uncomfortable with it too. So it's a legitimate concern even in their eyes. Yeah. So there's a way for a Democrat to come back to them and say, listen, I am not anti-crypto. Don't go nuts on me in an election because I'm here. I'm supporting digital assets. I'm not knee-jerk against you. But we've got to work out these problems with the bill, and you can see them too. And will that play? Will that work? I don't know. It might. I mean, I've seen some crypto pushback on that saying, no, we should put all our chips on the Republicans, ride the Republicans or die.
Yeah.
I don't know. There are enough elements in crypto that see some issues here that it's given them some pause. There are other issues that they want. I mean, I think the Dems want greater anti-money laundering controls, greater protections for not to blow up the system. We don't know exactly what the specifics are, but we do know there are high-level, high-stakes negotiations going on between Schumer and Senator Lummis, between Senator Thune and Senator Schumer. I mean, it feels like they're trying to reach a deal, but I can't tell you how far apart they are.
Yeah, it's funny too, right? Because the easy way to knock out a big part of the objection would be a very simple amendment banning government officials from having an ownership stake in any company that issues a stablecoin. Like, simple amendment, really pretty easy to write, tack it on, and I think you probably cleared away your problem. But as you sort of referenced earlier, even if there are Republicans who are sort of nervous or upset about this behind closed doors, they're not going to back an amendment like that, right? They can't. Yeah. And so it's sort of, it kind of poses this interesting question as to what can Democrats live with in terms of Trump's participation in the crypto ecosystem and competition in the crypto ecosystem? And what, I guess, other concessions can they extract from Republicans to get on board with that? Because it feels like even though that's the precipitating event that's sort of driving a wedge here, it's also the thing that's like Republicans are just never going to like take a stand on or push back on. And so it's kind of a question for Democrats as to whether they can accept that and exact other concessions, or if they just can't and they end up kind of being far apart on this. So I'll be curious to see how that plays itself out. And to your point, I mean, I don't necessarily get the sense, there are some Democrats, obviously, who don't feel this way, but a lot of them, to your point, I think are kind of intrigued in a neutral fashion around stablecoins and digital assets. Like they can see an argument for, strengthening the dollar and making the dollar more sort of competitive on a global stage, which actually might be sort of a nice counterbalance to some of the challenges we're having with tariffs and other sort of economic policy coming out of the White House. So you can sort of see how there could be sort of neutral interest on the part of Democrats, all other things being even, around stablecoins. It's just this has thrown a big sort of curveball right in the middle of a rather sensitive negotiation, which, as you pointed out, is moving at sort of warp speed relative to the way these bills normally go through Congress. Rob, I want to ask more broadly about stablecoins and your view on them, because My view has very much evolved as I've been sort of learning more about this legislation and sort of the parameters of it and the effect that it would have. And, we talked about the fact that it's moving fast and that it sort of seems to be catching industry off guard. I have seen numerous folks comment on this, and I agree with this comment that bankers and bank trade associations seem more, I don't know what the word is, sanguine, unconcerned, not focused on stablecoins relative to other sort of regulatory lobbying priorities. And that, from my perspective, is interesting because I can look at stablecoins, a regulated payment stablecoin, the way that the Stable Act and the Genius Act sort of frame them, as a pretty big disruptive threat to banks if they were to sort of grow the way that their advocates and supporters think that they might. What's your belief on sort of the larger disruptive impact of stablecoins, and how do banks that you talk to kind of think about that?
You are asking the right question, which is, how disruptive is this to banks? And the answer is potentially very. If you're asking me personally, I see it being very disruptive. And we don't have to go, you don't have to take my word for it. We can just look at money market mutual funds, right? The stablecoins act structurally a lot like it, different purpose, but they act a lot like it.
Yeah.
So back in the 1970s, when MMFs came online, they were a very small, like marginal business.
Mm-hmm.
There were not a lot of deposits going to them. People weren't investing in them. And then due to some changes that were made at the statutory level in the 70s and 80s, all of a sudden they took off. I mean, if you look at the numbers, they went from like 0.03% of, deposits to all of a sudden 5-10%. We are looking at another event that could be like that. Now, is it necessarily going to happen? No. And some people will tell you it's a payment mechanism. It's not going to be like, it's going to be more akin to Visa and MasterCard and less akin to MMFs. I personally would question that, because what seems to me to be happening is we have a bill that says banks can own stablecoins, fine. Non-banks can also own stablecoins. I don't know how many of your listeners are aware, there's just been a huge fight forever on whether or not commercial firms can get into banking. There used to be a fight over Walmart could own a bank. And that was rounds and rounds and rounds. And you're talking about the community trade, the bank trade groups. The banking trade groups fought off Walmart successfully.
Yeah.
And this is that, but potentially much bigger, because not only can Walmart go start a stable coin, but Amazon and Meta and Apple and you name it. And all they need to do is figure out a way to incentivize consumers to put money into their stable coin effectively at their bank. We're not calling it a bank and they can't make loans, but that's what they're doing.
Yeah.
And all they need to do is figure out a way to incentivize that. And there's certain things in the bill that say that they won't address that. For example, you can't, supposedly you can't pay interest on it. Look, banks know there's a way around that. Back in the 1980s, there used to be interest rate controls. So how did banks get around that? They gave away free toasters.
Yeah.
Okay. And you're telling me Amazon, the number one retailer in the friggin' world, cannot figure out a way to make a digital equivalent of a free toaster?
They have a lot of toasters, Rob. They have a lot of toasters just sitting in warehouses. They could send you toasters. They could bring that exact thing back.
Be a literal toaster. We could be all back to it. Or it could be $5 off or 5% off or a free beanie baby. I mean, whatever it is, Amazon's got a way. Walmart's going to have a way. Meta's going to have a way. Apple's really smart. So,
well, shit. I mean, didn't PayPal just announce that they were going to be doing rewards, which is essentially interest? And, again, like the exact mechanisms that are allowed or not allowed by the bill, it kind of, we'll see what happens. But I thought PayPal doing that in advance of the bill being done was a pretty aggressive, we are going to do this. We think this should be allowed. We think there's probably a way to make this work, even if you do technically ban us giving yield on stable coins. You see this happening. You see, I think it's Figure launched a stable coin. That one is, I think, regulated as a security, right? So that's a different.
They're paying interest,
Yeah, and they're paying interest. So that's kind of regulated as a security by the SEC. So there are ways around that. And to your point, just to build on what you were saying, The other thing I was thinking about is this reminds me a lot of the difference between banking as a service versus starting like a bank, right? So, if you kind of say, oh, yes, technically someone like a Walmart or a GM or, Toyota or whomever can get a bank charter. Maybe they get an industrial bank charter out of Utah or whatever state they choose
Right.
to work out of. Like, yes, it is accessible. Trade groups might push back on certain ones like Walmart and kill them. Smaller ones might slip through. Sometimes the window is open for acquiring banks or starting a de novo bank. Sometimes it's a little more closed. But like, there's sort of a trickle that's always sort of happening of new entrants getting into the space. When you compare that model of adding competition to banking versus banking as a service is just like, here's a development platform you can build on top of charters, go nuts. To me, stablecoins sort of are like the BaaS equivalent to the money market funds, as you were mentioning, because you don't really have to start your own now. You can just build on top of stablecoins. And oh, by the way, the difference between banking as a service and stablecoins is in banking as a service, the money still stays with banks, right? Like the deposits still sit in a bank somewhere, even though on the front it's some other brand that is working with the end customer. The payment revenue is still going to banks, or at least a portion of it is still going to banks. Like those things, those benefits are still accruing to the banking industry through banking as a service. It's just sort of shifting volumes around and picking different winners and losers. Stablecoins is that level of like infrastructure unlock in the same way that BaaS was, but it sits outside the banking regulatory perimeter. That's a pretty big difference. Looking to grow your fintech with scalable API-enabled payments? Newline by Fifth Third empowers enterprise companies to accept and process payments seamlessly. Effortlessly launch and scale payment, card, and deposit products directly with Fifth Third Bank. Learn more at newline53.com. Do you need more? More time? More revenue? More growth? Software companies are born global, but the complexity of selling worldwide can be overwhelming. Managing payments, sales tax, fraud, refunds, these things slow you down, but getting them right is essential. That's why over 5,000 digital businesses choose Paddle as their merchant of record, or MOR. More. Complete sales tax compliance globally, multi-currency payments, fraud protection, billing support, all taken care of. With Paddle's MOR model, you get more. More time, more revenue, more growth. Learn more at paddle.com.
This is huge, and the implications are huge. And there's a man named Mark Flannery, who's a former chief economist of the SEC, former senior official at the FDIC. He did an analysis a few years ago that said that you could see $1 trillion leave the banking system and go for this. And keep in mind, they're going to go to stablecoins, and stablecoins are not lending platforms. They are not banks. So where is that money coming from? It's coming from the banking system.
Yeah.
That lends that money out. So you are at the risk of, lessening the availability of credit. If you had a recession, you could see why that would also be bad and contribute to their recession. At the same time, you're asking non-banks to get effectively into the banking sphere. And then we can debate what happens with the reserves. Most of the time, the stablecoin is going to put the money in treasuries. That they need to have one-for-one reserves. That's the idea. They always have to be backed. They could put it at banks, but you're going to probably earn a higher return putting in treasuries. And that may be the point. That's what Senator Rand Paul said the other day. He was raising some reservations about the stablecoin bill because he said, I'm beginning to think that some of the point of this is just to drive up demand for treasuries, which this would effectively do. But we're talking about, we've seen estimates that, 1 trillion may be the low end of what this is. There are people throwing around 10 trillion and other estimates. So this is a massive deal, and it could fundamentally rechange the way financial services are happening, assuming that these commercial entities find a way to crack the nut and, find a way to make an Amazon coin work or a PayPal coin work, whatever it is. And I think this bill will open up a lot of avenues to do that. And I think if you talk to the banking trade groups, they would tell you that they've been very engaged on this. I think as an objective outsider, and they don't necessarily like me putting it this way, they have not been making as much noise on this relative to other priorities, hearkening back to the fight over Walmart, for example.
Yeah.
Or, even in comparison to 1071, the
I was just
requirement
gonna
in Dodd-Frank
say
Act.
that's a great example of one where it's like 1071 bugs the crap out of banks, right? They like hate it. And because they're commercial lenders in their heart of hearts, they understand very intimately like what 1071 would do and how much harder it would make their lives. And so they sort of live 1071's implications in a much more tangible way and get all worked up about it. And so when you compare like the lobbying around that to this, what strikes me is it's kind of the difference between like knowable risks and unknowable risks, right? Like a knowable risk is one that like you're going to like really strenuously try to push back on or mitigate or manage. An unknowable risk is one where it's just harder for you to imagine this thing happening. And so you're not going to take it as seriously. And it does seem, I've heard the same thing from bank trade groups like, no, we're talking to regulators, we're expressing our concerns. And it's like, given the scale of the potential disruptive impact it would have, and Walmart's a great sort of historical analog. Like I've seen what it looks like when you throw your bodies collectively in front of something to stop it. This is not that.
Right.
But it's the same or potentially greater scale of disruptive impact than Walmart getting a bank charter, quite frankly. Like this is that, except times 1,000, because it could be Walmart and all of the other companies that you worry about competing with you. The other point I just want to touch on real fast before I move us to one last topic is you touched on credit availability. And this is like the policy thing that I think is not getting discussed enough. I read a lot of like kind of analysis from pro crypto, pro stablecoin folks, including people who I really have a lot of respect for and I think are very good analysts who are sober in the way that they sort of think about crypto and how it sort of meshes with traditional finance. But all of them have a very sort of, I guess I would say, jaded view of fractional reserve banking as like a system. And I completely understand why, right? Like if you're alive now, you probably lived through the great financial crisis, at least if you're sort of talking about bank or fintech things. And I'm sure that sort of shaped your worldview about banks and how responsible they are as actors in our economy and all that kind of stuff. So I can understand being sort of skeptical about the idea that like banks play like a critical sort of socially useful role in our economy and in the global economy. However, just if you think about it from a first principles perspective, credit availability is super important to economic activity, to entrepreneurial activity, to risk taking, just like it is the lubrication that sort of drives our entire economy. And banks play an incredibly important role in essentially making deposits and individual depositors who would not want to fund risky things with their own nest egg, sort of making the alchemy necessary for that money to flow to risk taking and to entrepreneurial activity. And, people will cite things like private credit and the sort of growth of private credit as, oh, there are other mechanisms to do that. But I am here to tell you, having studied the history of this a little bit, versions of private credit have been around forever, right? Like it stretches back through the entire history of the United States, well before the Federal Reserve and a lot of the sort of institutions that we have today. The problem with private credit is it is cyclical, right? So when we are in sort of an investment stage from a macroeconomic perspective, private credit booms and people are looking for risk-adjusted returns and they'll funnel money into lending to businesses and to individuals. When the environment changes and when we are in a recession or when the credit cycle turns, that's when private credit, private investors, that's when that money dries up, right? And so I think the challenge I have with this stablecoin view of the world is, we'll just sort of break every part of banking into its own sort of individual job. Like these people will take money and keep it safe. These people will facilitate payments. These people will do lending. That works when everyone is happy and everyone is in sort of a risk on mode. I don't think it works nearly as well when that's not the case. I'd love your view on that.
I think this is a real issue that we're talking about. If you're talking about 1 trillion coming out of the banking system or 10 trillion coming out of the banking system, it's going to places that aren't making those loans, that aren't making credit availability. It's possibly very likely coming out of community banks and would lead to more consolidation in that sector. And that is not just a bad thing, but a terrible thing, because you get this a lot, and we may have talked about it before. Is this, there's this sort of attitude like we have 4,000 some banks in the country. We don't need that many. Well, actually, you do. I mean, there are a lot of places that are banking deserts. There are a lot of rural areas or other areas in urban centers that aren't necessarily being serviced by the big banks. And
Yeah.
there isn't a way for that mom and pop store to start up. There's not a way for that entrepreneur to get a loan. And they're doing that through community banks. Community banks remain the bulk of small business lending in this country because they're the ones that can take that risk and understand where that borrower is coming from. And I think if you start watching this money just get sucked away to things like Amazon coin, Apple coin, whatever it is, you are just losing a tremendous amount, and you are losing part of the engine that drives the economy. And I don't think enough attention has been paid to that. And frankly, I feel like policymakers in general, and this is true of both parties, tend to pay a lot of lip service to community banks. But then when the chips come down, there's not a lot that's done, or it's done around the edges of helping them. And you end up in these situations where you have other policy that's actually actively could end up hurting them. And there hasn't been an attempt really to mitigate that. That's at least obvious from the outside.
I completely agree with that. I will also say that over time, I've definitely noticed more of a schism form from a bank, trade association, and policy perspective, where it's like, I mean, I was thinking about this from a stablecoin perspective. A stablecoin is not really a problem for JP Morgan Chase, right?
No,
like they're gonna figure it out. They're gonna be fine. Correct. They will probably issue a stablecoin. They also have enough of sort of a fortress of a balance sheet and like a really, really strong, sort of immutably strong deposit franchise. Like they're going to be fine. Stablecoins are not a threat to them. But stablecoins are a huge threat to small regional and community banks, many of which, like if they see, a dip in deposits, that's the difference between being in business or not. And they don't have like a real good way to replace that.
Right.
And, so it is, I think, challenging when you see some bank trade associations that are maybe more skewed to big banks going like, this doesn't really seem like the hill we want to die on. I think we'll be fine here. Let's fight on some other issue versus, ICBA or some other trade association that's much more focused on community banks that's kind of doing their best to like rally the industry and express concerns about this. But not everyone is necessarily on the same page. Even if banks globally have a problem with stablecoins, the individual parts of the banking industry might not all agree on the prioritization of stablecoins. So I think that is definitely an issue.
It is definitely an issue. And definitely the big banks view this differently than the small banks do. And frankly, the small banks have been focused on other issues that are also really important. So that's, and so some of this has been hypothetical. And I think there was a fair amount of cynicism in the fact that that stablecoins have been sitting around for 3 years. So people have sort of felt like it's not going anywhere. And then suddenly it was going somewhere. And at the grassroots level, bankers were not as aware of it. I'm still surprised when I give talks to bankers. This may be one of the first times they're really having someone walk them through the bill. And again, that's not, if they're attending the ICBA conference, that's not true. I know I've been at the conference where they talk about it, but if you're not at that level, then they're not. And so they are not as engaged on this issue as they might otherwise be if if all the implications were immediately clear.
No, that's very true. I mean, I was at CBA Live earlier this year, and I actually was on a panel on stablecoins, and it was very much one of those things where like it was clear we were the first people talking to a lot of the people in the room about stablecoins, and like that was, and credit to CBA, they made it a priority and a main stage thing they wanted to talk about. But it was the first time a lot of those bankers were getting exposed to like, what even is a stable coin? Why should I worry about it? What are the opportunities? And so,
why am I worried about this? Right.
Yeah.
Why are you talking to me about this?
And it's, and it went from like there to now we're just about to have a bill be done. Like it's moving so fast that they haven't maybe been able to fully wrap their heads around it. So no, I completely agree with that. Before I let you go, let's hit some quick topics, little lightning round style. I want to ask you about open banking. Because this is the other sort of big news that's come up recently is that there's been some reporting. Our friend Evan Weinberger at Bloomberg reported, and I've heard similar stuff kind of behind the scenes, that the CFPB under acting director vote is considering basically two paths as it relates to open banking, which is currently the subject of a lawsuit from the Bank Policy Institute. One path is to reopen rulemaking on the existing rule and to essentially make some changes to it. Banks have a nice long laundry list of things they would like to see that they feel like they were shut out about under the Biden administration when
Right.
Director Chopra was sort of running point on the rule. These things include like better sort of protections around liability, more control over third-party risk management, notably being able to charge for the data, things like that. So one path is to essentially open up sort of revised rulemaking on the rule and to allow industry to have sort of another crack at making some changes to it. That would also, I imagine, come on the fintech side as well. There's things that fintech companies aren't happy with the rule, and they would have their chance to sort of push for some things there as well. That is what I expected to happen once the Trump won in November, and kind of squaring that with the BPI lawsuit. Like I sort of thought that's where we would end up. However, what I'm hearing is that there's also a reasonable chance, and I don't know if I could put a percentage on it, but a decent chance that rather than kind of going through sort of opening the rule back up and more rulemaking, that the CFPB just decides to rescind the rule and maybe at some point in the future create a new version of the rule down the road. In some ways, that is the more expedient path for the CFPB, particularly when you consider the fact that there's hardly anyone working at the CFPB anymore.
Correct.
And they don't really have the resources to go through a whole APA-driven rulemaking process at this moment to revise the rule. And it all kind of touches on this like tension between acting director Vogt, who has been very focused on sort of slowing down, stripping, cutting back, and some of the other folks like Mark Calabria, I think McKernan, who's still sort of waiting to get at the helm of the CFPB, who have maybe a slightly different vision of what the Bureau should be doing. So these two different paths are both on the table. I don't know that we know exactly how it's going to shake out right now, but Rob, what have you heard? What have you seen on this one?
I think what's fascinating about it is how much we don't know. You correctly assessed the situation when you said we have a CFPB that's sitting there and doesn't really have any people. So if you're going to rework a rule and your rulemaking department is only 10 people and that's not the only rule, that is going to take forever. It is easier to rescind and let the chips where they fall where they may. But I have to say that's not universally popular among Republicans. I mean, let's remember when this rule came out, you saw then Chairman Patrick McHenry praising the rule. And I can count on one hand how many times the Republican chairman of the House Financial Services Committee has praised the Democratic CFPB director.
Right.
That was one of those times. So granted, he's not in power anymore, but there are plenty in the fintech world that like the way the rule came out. Maybe they would want to change some elements. But bankers do not feel as positively about it, and as evidenced by the lawsuits against it. So they would be very happy if this got rescinded and kicked to later. And at this stage, I don't know who in the CFPB is going to pick up the pieces and rework it, or if they did, how long that would take. And again, these agencies are big for a reason, and it's so they can do as many things as they can do at once. And typically, even big agencies can take an extraordinarily long time to work on rules because the devil is absolutely in the details.
I mean, this took 5 years to get done. I mean, right? It's like this is not a short process, even with a well-staffed CFPB.
So if they're going to reopen it and take comments, then they've got to have somebody. I mean, just think about that for a moment. They reopen it. They say, we're putting on a pause. Everybody, let's take your comments. Tell us what we got wrong. Somebody's got to read those comments. And there will be tens of thousands of them. And that alone, unless you have a great AI program that's authorized for this, and they don't, I'm just theoretically making that up, so that can synthesize all this in an easy way, there's going to be no way around that problem. So yes, it is far easier and makes more sense for them to be like, we're uncomfortable with this rule. We are either permanently putting it on ice or we're delaying the enforcement date until kingdom come. But it's easier for them to rescind than not. And it will be fascinating to see if that's their solution to sort of way out of the box, or if Jonathan McKernan gets confirmed and says, you know what, the staff cuts don't need to happen to this level. I'm going to keep it, at least in the rulemaking department. I want to make some changes. The industry wants to make some changes. Let's give me a little bit of running room to do that. And that is still a possibility.
Yeah, no, it is. It absolutely is. I think the important thing to note on the CFPB cuts is that they're happening in different ways, right? And so obviously there's the rifts that have been happening in terms of just getting rid of people. That is kind of under legal challenge right now. So some of that might get sort of reversed or rolled back. But then there's also, I think, a proposal in the House of Representatives to cut the CFPB's budget by about 70%, right? And so like it's hard to say, to your point, once McKernan eventually gets at the helm of the CFPB, which I still think is probably likely to happen, it seems, once he eventually gets to the helm, what does he decide to do in terms of staffing, and how tied are his hands in terms of the budget that's available to him? And then how does that drive the decisions here? I will say, just real quickly before we get to some other quick lightning round questions, this is one of those things where rules are good because it sort of like levels the playing field for everyone, and everyone has to kind of compete on an even footing. It's sort of like driving a car down a sort of modern street. Like there's traffic signs, there's rules, you can turn right on red, but you have to stop first, all these kind of things. Open banking without rules is much more like Mad Max Fury Road, right? Where it's like the person with the biggest rig that can just sort of shove everyone else out of the way tends to dominate. And, I mentioned that only to say that, the banks behind the BPI lawsuit are the biggest cars on the road that can sort of force everyone else to the side, right? And so if, again, we'll pick on JP Morgan Chase just because they're the biggest, and so that's sort of the cost you have to pay. Like their interest in this, I think, probably aligns with the idea that they have the leverage and the size and the scale and the on us data to kind of get whatever they want around open banking. They don't need to have a set of rules that level the playing field for everyone else. It's fintech companies, smaller banks, even community banks that will find themselves in a very unlevel playing field if the rule gets rescinded. So I think the consequences, again, not falling evenly on every part of the banking industry is something to note with open banking as well.
Yeah, that will be very interesting to see how all that shakes out. But you're right. It's not been well thought through what happens if you just take it all back.
I would tend to agree. All right, Rob, now we're going to go into like hyper lightning round mode. We're going to move fast. I want fast, just off the cuff answers. Are you ready?
I'm ready.
Okay, here we go. Is the California DFPI order against Hatch Bank, which I wrote about in my newsletter, a sign of things to come?
Yes, because when the CFPB takes a step back, you're going to watch blue states take a step forward, and they're going to feel like they have to lean forward more. Now, can they replicate everything a democratic CFPB can do? No, they cannot. So it's a little bit more limited. You're still going to see less enforcement than you did. But yeah, absolutely. Those blue state attorney generals are going to want to be out in front on issues like this. So yes.
Mm-hmm. Okay, perfect. I agree with that. What's one law or rule relevant to financial services that isn't getting enough attention right now? You can't pick stablecoins because we already talked about that one.
No, I want to pick stablecoins. That's exactly what I want to pick, because I do feel like for all the discussion that you and I are having, and you're talking about it and I'm talking about it on our shows, it is not well understood.
I totally agree.
Beyond that, I do think there are issues around, community bank health and basically keeping, for all the talk that we have about helping community banks, there hasn't been as much policy around it as I'd like to see. It tends to be more like, we're going to help the small banks, and then someone starts talking about how they're going to change Basel III, and it's like, well, that doesn't actually impact.
It's a great point, right? It's like community banks is like the sort of Pledge of Allegiance thing that everyone does just to sort of demonstrate that they're like civically minded, but it doesn't actually make its way into policy discussions. I think that's actually a very, very good observation. All right, next, will we see the Trump administration regulators ignore the APA as President Trump's recent executive orders seem to be slightly encouraging?
I'm going to say no. And the reason I'm going to say no is because those regulators that have been nominated for those positions they're all known entities,
right?
And they're all by the book kind of people. Jonathan Gould, who
I was just going to say, he's a great example.
He's a former general counsel at the OCC, now running the OCC. He's a by the book kind of guy, and they want to do policy changes that are lasting. And to the extent that you ignore the APA, you are opening yourself up to it not being lasting. It's the same all the way down the line, Travis Hill, assuming he stays as acting chairman or permanent chairman at the FDIC, same thing. Jonathan McCarran at the CFPB has said several times, I'm going to follow the law. So I don't think you're going to see them flaunt the law in quite the way some of these executive orders may be suggesting they could.
Got it. Okay. I think that is encouraging. What's one specific thing that you think Michelle Bowman, who is moving along the process of becoming vice chair of supervision, will do once she is officially in that role?
I think she's going to be taking a look at liquidity standards. That's something that she's talked a lot about. She's a very, very thoughtful regulator. And yeah, she'll get to, I mean, I think she will be heavily involved in the Basel III rewrite, but it's something that back to our earlier conversation, Treasury Secretary Scott Bessant has talked about liquidity. That's really a Fed area to determine how we're going to make sure that we have enough, banks have enough money on hand that they can survive a crisis or a run, which is hard to do given what we call it Silicon Valley Bank, where we saw, $100 billion leaving the bank in one day. So I think that's one area she's going to be taking a hard look at very early on.
Awesome. All right. Really, really quickly. Rob, dogs or cats?
Cats.
Cool.
Come on, they're just cooler. Sorry, you're cooler.
That's fine. I will say I've known some very cool cats, so I can accept that answer. Most underrated movie?
My God, you hinted to me yesterday you were going to ask me this question, and my mind blanked. Normally, I could come up with one.
Rob.
And there were just too many damn options. I'm like, underrated movie. I mean, I feel like just saying Pride and Prejudice to make Kia happy. That's
that's good. That's good. That also that also would make my wife very happy. She never listens to the podcast, but she would agree with that as well. So that's a strong take.
But the real thing is, I don't think Star Trek II: The Wrath of Khan gets enough.
So you have a Star Trek poster on your wall for people who are watching the video of this. So I was wondering if Star Trek was, so you think Wrath of Khan, which is considered to be a great movie, you still think it doesn't get the credit it deserves? I'm not going to fight you on this.
Because you see so much attention around the Star Wars, and they just re-released Revenge of the Sith in the theaters, and everybody kind of goes nuts in Star Wars this. I think Star Trek tends to get the shaft. Yeah, my son picked up that poster. IntraFi is a very Star Trek friendly place, even though we have a replica of Han Solo and Carbonite in our cafe. But we even have conference rooms named after Star Trek episodes. So it is. And I was not responsible for that. That was the way it was when I came here. So yes, widely regarded as the best Star Trek movie, but Star Trek overall, I feel like doesn't get the attention sort of that it deserves, or that movie in particular as being a modern day Moby Dick.
Wrath of Khan rules for people who haven't seen it. Like, you sort of sometimes get nervous about like movies that are past a certain age. Like, it completely holds up. It's incredible. So good. I will also say Voyage Home is super underrated, and I love it. So I'm with you on Star Trek.
Not going to mess with 2, 3, and 4 right there. 3 gets a little funky and get a little weird, but it's still overall, that's just a fantastic trilogy. It's hard to beat.
I strenuously agree. All right. And then you mentioned Kia Hazlitt. In honor of Kia Hazlitt, last question. Which form of potato, fries, tots, mashed, whatever you want, is the best form of potato?
Fried. Crispy fries with sea salt on them. Just chef's kiss. Magnifique.
Yes. And you don't agree with Kia that like beer battered fries are better than like fresh cut fries, right? Like, to me, like fresh cut fry, little bit of sea salt on them.
Yeah, no, I'm good. Yeah, I would like sea salt and a little bit of ketchup.
Yes, okay, I'm with you. Fries are perfection. Like, French fries are perfection, and there really is no other answer. All right, Rob, you passed all of the tests.
You have to ask me what my favorite U2 album is.
That's a great question. Let's end there. What is your favorite U2 album?
I demand you ask this of all guests going forward. Octune Baby, released in the 1990s, radically changed U2 sound. We take it for granted now, but remember, they were going from I Still Haven't Found What I'm Looking For to The Fly, and if you put those tracks back to back, they don't sound like the same band producing them, and every track on Octune Baby is a banger.
Yes, I love it. Okay, that is a great one. Actually, is someone who's in a somewhat creative field at times, at least I like to think. I actually admire artists who are very like sort of risk-taking from a creative perspective. So love that answer, and I will carry that forward as a question into future lightning rounds. Rob Blackwell, thank you for your time.
Alex, thank you so much for having me on. I really appreciate it.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.